Very much. My name is Richard Yetsanger. I'm Chief Economist at ANZ. I'm also on the board of CEDA, so I'm the CEDA representative here today. Welcome to today's event. I would like to acknowledge the traditional custodians of the land on which we meet, the Gadigal people of the Eora Nation, and pay my respect to their elders, past, present and emerging. This was, is and always will be Aboriginal land. These events are not possible without some great sponsorship, so thank you today to Plenary Group, a sponsor of this event again. We really appreciate it. Plenary's been a CEDA member since 2006. Also thank you to T Corp, CEDA member since 1990. You can't beat them if you join CEDA today, but you can benefit from some great ideas. So if you're not a member, I'm happy to talk to you about that. I'd also like to acknowledge New South Wales Treasurer, the Honourable Daniel Mookhey, for speaking to CEDA again today. Courtney Houssos, Minister for a bunch of stuff, Finance, Domestic Manufacturing, Government Procurement, and Minister for Natural Resources. What a fantastic list, very, very busy. At CEDA, our ambition is summarised in our Progress 2050 agenda. It's about contributing to a prosperous future for all Australians, built both on a strong economy and a strong social compact. We have a number of principles underlying our Progress 2050 agenda, but most importantly, in this context, productivity, investment and innovation, all of which I'm sure the Treasurer will be speaking about today. While we're having a membership discussion later, I'm happy to talk to you about Progress 2050 as well, if you would like. I'd like to also acknowledge we have some representatives from the media here today. Thank you very much for your support of CEDA and our events. The conversation today is an opportunity for all of us, so please participate either in social media or in the room. If you would like to pose a question for the Treasurer to get answered later, the Pigeonhole app is how we will do it. The QR code is on your table, on the red coloured sign on your table. The password is pretty easy, New South Wales Budget, all one word, all in uppercase. Also on your table, if you scan one of the QR codes, there's a list of attendees in the room if you'd like to connect with people later. The only reason you're on your phone is to pose a question to the Treasurer, of course, and all phones on silent, need I say. The outline for the event, pretty simple. I will leave the stage in a minute. Dave Deverell, the Chief Executive of T Corp, will come up to introduce the Treasurer. Following the Treasurer's address, we will have some lunch, and then the Treasurer will return with some questions facilitated by Plenary Group's Patrick Lauren. Thank you very much, Dave Deverell.
Thank you and good afternoon, everybody. I recognise that the Treasurer and I are standing between you and a nice lunch, so I'll try and keep my comments brief, but very much welcome you all here today. I also recognise we're on Gadigal land and pay my respects too. Now, this is my 10th year as the presenting at a budget lunch as the Chief Executive of T Corp. I'm very proud to be a member of CEDA since I didn't realise it was 1990. So that's fantastic. And so we're very proud to be here and sponsoring this event today. It's great to see so many familiar faces in the room, whether it be investors in our bonds, panel banks that help get to those investors, members of the New South Wales government family, as we like to call it, many of whom are clients for us. We've got a good contingent of T Corp staff and directors as well, and a big shout out in particular to our colleagues in Treasury and the Treasurer's office, with whom we work so closely to help the government achieve its fiscal strategy. So that's really welcome to everybody there. Now, there are probably many other new faces in the room today who probably aren't quite so familiar with T Corp and the role that we play working with the government. And so I'll just give you a couple of slides just before I introduce the Treasurer to give you an update what we've been up to and the role that we play in helping the government achieve its fiscal outcome. So just by way of background, if this clicker works, there we go. So T Corp, we're fully owned by the New South Wales Government. So we've been around since 1983, and our shareholding minister is the Treasurer of New South Wales, Daniel Mookhey. We do two things. We act as the state's financing authority or central borrowing authority, and we borrowed roughly around about $200 billion on behalf of the New South Wales Government. The second role we play is as an investor. So the government has a substantial investment portfolio, just under $120 billion, and we look after that. Our whole objective is to help the government achieve and deliver its fiscal strategy over the long term. So how do we do that? Well, there's lots of, I could put lots of complicated charts up, but at its core, how do we do that? Firstly, we do that by minimising borrowing costs and refinancing tasks. And that all sounds pretty boring, but it's actually hugely important. With a substantially grown balance sheet over the last number of years, particularly post-COVID, every single basis points that we can save for the government is worth a hell of a lot of money. So we've got a ruthless focus and relentless focus on that. The second side of things is that we're relying increasingly on foreign capital to fund our borrowing program. And so we do what we think is a good job promoting New South Wales government to the global market, because it is a globally competitive world for capital. And with our strong credit rating, our attractive yield and the deep liquidity in our bonds, we're pretty attractive when as we take up our story offshore. The third thing that we do, and this is more on the investment side of things, our job is to deliver strong and sustainable investment returns. The Treasurer has set us a fairly aggressive investment objective of CPI plus 4.5 in our portfolios. And to do this, we manage truly globally diversified investment portfolios, everything from cash, equities, through to real assets or private assets, as you might call them, both domestically and increasingly offshore as well. So what I'll just do now very briefly is give you some examples of how we're particularly trying to help the government achieve those objectives of fiscal strategy, but particularly around minimising borrowing costs, but also delivering stronger returns. Now this next chart is one that many of you might be familiar with if you've been coming to these lunches for a number of years, and this is our borrowing program over the next 4 years, or the forward estimates. Now there are 2 points I'd like to make amongst this busy series of numbers. The first point is that as of yesterday's budget, our borrowing task is $7 billion lower than what it was projected to be at the half year. That's good. $7 billion less debt, and all the interest we have to pay on that is a good thing. The second thing, and subtly in there, but really importantly, you'll see a line up there that's called general government. That's the funding of the general government's requirements, not only in terms of running the state, but particularly in terms of its very, very significant productive infrastructure program, which is totalling well over $100 billion over the next 4 years. What you're seeing there is a substantial reduction in the new borrowing required, particularly in the outer years. And that's being driven by the fiscal discipline that's laid out in this budget, where the cash being generated is now getting to the point where it's almost at the point where it's funding all of the borrowing, the infrastructure program. And that is really good fiscal management. It's something that the New South Wales government is doing, and we look forward to seeing some of the states, the other states, following this discipline as well. And all of that is really good news. So that's all I'll say about our borrowing program. It's still in the $20 billions, but compared to, I think, Victoria and Queensland, well into the $30 billions, and they're smaller states than us. So they've got a much, much, much bigger program, and we're delighted to have a more modest program. What does that all mean? Well, ultimately, we serve the great master in the sky, which is the bond markets. And the bond markets judge us every day on what we do. So what this chart is an attempt to show, what do the bond markets think of what this government is doing? So there's a vertical axis here. The vertical axis basically shows the cost of our borrowing relative to our peers in Victoria and Queensland, the black line and the red line. A higher number means it's more expensive, and a lower number means it's cheaper. The horizontal axis shows a timeline from March of 2023. We chose that because that's when this government was elected. So what you can see here is a good news story. So what it's saying is that the market, the bond market, which is never wrong, always right, is saying that the things that the government is doing and we're doing to assist the government is actually making the cost of our borrowing lower than it would have been otherwise. Now, those differences, these are in the basis points. So you see the red line, you know, it's probably roughly 20 basis points cheaper than it was 2 years ago. And you think, well, 20 basis points or 0.2%, that's not a lot of money. Well, it is, because on $100 billion, that's $200 million per annum. On $200 billion, that's $400 million per annum. That's a lot of money that can be spent on other things. And so that's where we're delighted to be helping to support the government in its endeavours to have a strategy of fiscal repair to drive lower borrowing costs for the state of New South Wales. So the bond markets have spoken, they like us, but as always, keep reminding the Treasurer they can like you today and hate you tomorrow. So we have to be consistent on this message. Now, on the final point I was just going to make is on the investment side. Roughly 12 months ago, the government announced the creation of what we call the One Fund. And the One Fund is basically pooling now 9 different pools of money that used to be managed separately according to different investment strategies into a single fund, the One Fund. So it's now roughly $65 billion under management. Why one fund? Well, it's pretty sensible. If you can have a single investment strategy targeted on a very specific investment objective, you can run a much more efficient portfolio, which means holding lower cash holdings, which then means you can take that money and put into higher allocation into growth and diversifying assets, which then drives higher risk-adjusted returns. So since the fund commenced, and we've got nearly a 12-month track record, it's delivered returns of roughly $3.6 billion. Now, in anybody's money, $3.6 billion is a good thing to have on your balance sheet. So we're very proud of the way in which we're able to help drive a stronger balance sheet with the government. So in closing, really, we're proud to partner with the New South Wales government to deliver its fiscal strategy. You've seen the outcomes, working with them, driving lower borrowing costs and driving higher investment returns. What does that mean? It means a stronger New South Wales government balance sheet, which means a stronger New South Wales. And for most of you in the room, I'm sure you're from New South Wales, that's got to be a good thing. So with that, I'll close my comments and I'll welcome to the stage the Honourable Daniel Mookhey.
Well, thank you, David. And your description of the bond market, that it could love you today and hate you tomorrow, is also a good way of describing life in the labour movement as well. Good afternoon to everybody who's joined us for my third CEDA address. And can I take this opportunity to begin by acknowledging that we are on the land of the Gadigal and pay my respects to elders past, present and emerging, and take the opportunity to once more pledge the New South Wales Government's ongoing solidarity with all First Nations people as we strive to perfect this democracy by making sure its opportunities are available to all its citizens. Hello to all the civic leaders, all the business leaders, all the public service leaders and all the financial leaders who have joined us here this morning. It is a pleasure to be joining you for the third time at CEDA, and thank you to CEDA and thank you to Richard on behalf of the CEDA board, one of the nation's finest economists and a person who I've had the opportunity to read his work and his insight for many, many years. In fact, as an information-starved shadow treasurer, Richard Yatsunga's ANZ economic updates and briefings kept me not sounding as dumb as I otherwise would as well. So thank you as well for that. Can I take this opportunity also at this particular event, just point out and say thank you very much to the New South Wales Public Service, many of whom are in this room. And I did spend many years tormenting you in opposition, and I've now spent 3 years working with you in government. And that it is a huge asset for the state of New South Wales to have an independent, impartial public service to serve the interest of the government of the day, that is capable of undertaking complex public policy work and deep reform. And in this particular budget, there is a good sign in terms of what that means for the people of New South Wales. Because yesterday, we were able to announce a historic investment in child protection and a massive $1.2 billion increase to care for the state's most vulnerable children. And that is the result of 2 years of reform efforts led by the New South Wales Public Service, especially the Department of Community Justice and Secretary Tidball, and of course my Treasury and former Secretary of that department and the current Secretary of Treasury, Michael Coutts-Trotter, and the Cabinet Office and the TCO and the whole of the government. And that is the difference that an impartial, highly talented, quality public service can deliver, nowhere else could we have done that except here in New South Wales. So I wanted just to acknowledge all the people who have worked very hard to produce this budget across the public service. Treasury's here in quite heavy numbers, thank you to them as well. And of course to David and the team at T Corp, thank you very much. And David, for your 10 years of outstanding public service to the state of New South Wales, especially your 10th anniversary of a CEDA lunch. I should reflect on the T Corp contribution too, and simply ask you, it's good that you've reduced our borrowing costs, it's good that you've increased our investment returns, but what have you done for me lately? As well. I get to give the slideshow, and I think we're underway. I will be short, sharp and pertinent because I'm stopping you from having lunch. I don't know where the slideshow is, but I presume it's going to be on a screen pretty soon. Here it is. Yes, the budget show. This year, the Minister for Finance, who's here, my partner in fiscal responsibility, is here, and we decided we're going to have 4 pictures on the budgets this year, and here it is. These are the 4. We're pleased. We've gone from 1 last year to 4 this year, and that's just a sign of the confidence we have in the fiscal future of New South Wales. But I'm going to talk to you about our fiscal outlook. I'm pleased to show that some rather 3 years of some difficult decisions has meant that the New South Wales budget deficit has gone from a peak of $15.3 billion in 2021-2023 to we're likely to report a deficit of about $5.7 billion for this year, and a third. And that's been achieved despite a $12.6 billion impact on the state's finances last year as a result of the Commonwealth Grant Commission's GST decision. Pleasingly, we are showing, again, a pathway to a budget surplus in 2728 and 2829. Modest? Yes. Small? Yes. Precarious? Yes. Great degree of caution needs to be applied in interpreting that number. A lot needs to go right for the state of New South Wales to report it. But what is encouraging is that it's been created from the fundamental drivers of structural repair, which is, are you keeping your revenue growth higher than your expense growth? And I know in the first budget and second budget, there was a bit of scepticism about whether or not we would be able to keep our expense growth below its historic average. But I can report that we will, at the end of the 24-25 year, report lowest expense growth in quite a while. And we now have a bit of a record to show people about how we are doing this, and which raises the question as to why we're doing this. We are having to do our bit to wring inflationary pressure out of the economy. We are one of the nation's biggest economic spenders, the New South Wales government, on both our recurrent side and our capital side. And at a time where the nation has experienced a once-in-a-decades inflation spike, when we do need to make sure that we are taking inflationary pressures out, so we're not otherwise setting back household finances and cutting their real disposable income, so we're not risking permanently high interest rates that make it harder for business to invest as well. We have to do our bit. And that was what framed our economic strategy in Budgets 1. We've held to it to Budget 2. We hold to it in Budget 3 as well. And it's why we are able to say that we are expecting expense growth of about 2.4% over the next few years, down from a 5-year average in the years leading up to COVID of 6.2. Now, some of the commentary that I've seen in response to the budget, all of which has been really interesting, one of the points has been made is, well, is that realistic? And I would say, firstly, we've already shown this year that it is, and incidentally, the year before. But the second point I'd make is even if there's movements around the margin, structurally it's a lot better than it was. And so even if it hovers between that 2.4 to 2.8, that's still a lot lower than the 6.4 that has been reported previously. But equally, I'd also just say that's also why the government and the ERC and the Premier has made it clear that we have to do the structural repairs to the budget, the factors of our budget that otherwise mean that we are locking in expenses as well. And we'll talk a bit more about that as we continue. I can't resist the opportunity to simply point out how we compare to the other states when it comes to 2425 expense growth. And if you just look at the 2425 years, and granted, we will probably update these numbers to reflect yesterday's budgets from Queensland and the ACT, which is probably going to make this chart look better for New South Wales as well. But you can see we have achieved the second lowest expense growth in the country. And I would just point out by way of comparison that if you just go across the chart, I am envious of West Australia. I acknowledge that in the room we have the next Secretary of the WA Treasury who's with us as well. Congratulations, Joanne, on your appointment. And I'm sure you're looking forward to telling your new government that you will serve, about how they spend recklessly and they need to follow the New South Wales approach when it comes to expenses. And I would like to follow their approach when it comes to revenue as well. But there are pressures, and this is what I was talking about. What is the pressures that the budget is under? And what is causing the slippage right now? What is the structural pressures that we're having to deal with? And we haven't hidden in the lead up to this budget that a huge part of that is the cascading consequences of a failing workers' compensation system here in New South Wales. And when I talk about a failing workers' compensation system here in New South Wales, I say it's failing because it's not, when it comes to psychological injury, it's not doing its core job, which is to return workers to health and return them to work as fast as we can. And that's not working for injured workers, it's not working for business, and it's not working for the state as well. And I will say, as a Labor government, of course it's hard, and these involve quite difficult decisions as well. But we simply make the point that there's a better way, and we have proposed to the Parliament a better way. And is it a perfect way? Of course it's not. But it is better than the status quo. We say that it is. But for those who say that it's not, and those who are blocking reform, then amongst many of the other questions that they will need to answer is why then is $2.6 billion of additional expenditure in just 6 months a good use of public money? Why is that a good use of public money? Because we have had to, in this budget, budget for an additional $2.6 billion of expenses for 6 months. That is from the 30 June 2024 to the 31 December 2024 period of time, we've had to book an additional $2.6 billion. At last year's half-year review, we booked more than $1 billion. In last year's budget, we booked more than $1 billion. In fact, since I've been Treasurer, I've had to book out an additional $3+ billion on just the state's component of the workers' compensation system, which is why I say we could put this money to better use. We could put this money to much better use on behalf of the people of New South Wales. So we'll continue to make our case for reform, but we will continue to show people what the consequences are of the status quo when it comes to the state's balance sheet as well. Other point we should make is that as the climate changes, as the crisis develops, as we experience more natural disasters, that is surfacing in all of our nation's public finances. And here in New South Wales, in this budget, we've allocated an additional $4.2 billion to support communities that are recovering from disasters, as we should. But we also point out that in the 5 years leading to 2020, on average, the New South Wales government would spend $150 million on disaster recovery. We are now spending more than $1 billion each year, and we expect to be spending more. And Treasury has done some world-class leading work to model what the long-term consequences are of climate change on the New South Wales balance sheet. And you'll see more of that work by the Treasury team that is preparing the intergenerational report right now, and they are going to be using some of the world's leading methodology to estimate what the consequences are. But the long and short of it is even now we are having to use our balance sheet, we're having to use our public resources to help communities rebuild, as we should, but that is going to catalyse a conversation around broader reform, which is why in yesterday's budget we also provided an update about what the future of the emergency services levy here is in New South Wales, one of the first questions the state will have to grapple with. Let's talk about our interest expenses. This is when all the people from T Corp, please consider this a challenge. And do what you can to keep this lower, if you don't mind. But we are refinancing all the state's debt that was effectively borrowed during COVID by the end of this decade. And Money borrowed at the era of zero-bound interest rates is not being refinanced in the era of zero-bound interest rates. I said last year, and I'll say again, when I was Shadow Treasurer, my first budget that I had to respond to, New South Wales' 3-year debt was 0.43. First budget I gave, it was 4.98. You can see what that means as the interest expenses rise. Interest expenses remain the fastest growth of expenditure in the New South Wales budget, as it is in all budgets who are having to refinance COVID debt. This is my way of saying to the accountants in the rooms, I have a brief with you too. Depreciation and amortisation is coming through the budget. Not a surprise as you open big new infrastructure projects like metros. If you open roads, you start to depreciate them. And equally, turns out when you revalue schools, they end up being worth more than you thought. I still recall being told last year that we've revalued all the soft play areas of the New South Wales public schools, and turns out all the fake grass is worth a lot more than we thought. Coming through in the budget. The Finance Minister, or my partner in fiscal responsibility here, we led a comprehensive expenditure review in our first budget. It identified $11.9 billion worth of measures we could either improve or reprioritise. We said we would provide constant updates as to how we are going on realising those savings. We can say that $7.6 billion of those $11.9 billion is, as of now, complete, and we are looking forward to providing further updates as our time in government continues. Talking about employee-related expenses, again, the average employee-related expense growth from 2018 to 19, 2022, 23 was 6.4. It's 3.5 under this government. Slightly higher in the budget we updated yesterday. Why? Workers' compensation is the biggest reason why that expense has gone up. That is reported in this budget line. In terms of stamp duty, alas, there's no big revenue boom that's come to the rescue of the New South Wales budget in this particular year. There are some interesting movements around transfer duty, but $899 million worth of movements over a 4-year period of time is obviously welcome, but not particularly major variations as well. $512 million lower in payroll tax that is driven by a slightly weaker labour market outlook, but also, let's be honest, coming out of a very strong era of performance in our labour market, in which both employment's been very low and participation has been very high. It is the effect of effectively us going to some more normal settings in our labour market. There has been a $1.2 billion reduction in dividends and distributions, and some additional downward revisions in our dividend and income tax equivalents, predominantly as a result of some changes expected when it comes to our water utilities capital spending plans that has consequential and cascading impacts on our dividends and income tax equivalents. Mineral royalties, let's see what happens with the US dollar. Now, say it all with me. GST, New South Wales, we are getting a smaller share of a bigger pie. If I simply got the same share of the bigger pie first budget, we would be in a very different position in the structural position of New South Wales. I should take this opportunity to say that we're expecting the GST relativity to be about 86 cents in the dollar collected from New South Wales. When I became Treasurer, we were getting 93 cents in the dollar. Victoria was getting 96 cents in the dollar. Today, Victoria is getting $1.07 and we're getting 86. And that's a 21-cent spread, the highest in the 25 years since the GST was introduced. And I'm sure all of you will buy a birthday cake on 1 July to celebrate the 25th anniversary of the GST's implication in just a week's time. Debt is $9.4 billion less than it was forecast at the 2023 PBU, or pre-election budget outlook as well. We did say when we were in opposition that we would keep debt below $187 billion by that point in time. We are on track to meet that commitment and exceed it by keeping debt at roughly gross debt at $178 billion. That is quite a deliberate design of strategy that we have done in budgets 1, 2 and 3. It has been achieved despite the revenue loss we experienced in GST. We've been able to absorb the $12.6 billion that otherwise we would have received and still keep the gross debt levels down. And we've been able to do so while reducing our net debt as a proportion of GSP as well. And again, this is my opportunity to point out how we perform to the other states. No disrespect to the future WA Secretary Treasury, but we don't count you in this. Just FYI as well. In fact, actually, I don't know what the WA Treasury Secretary will need to do for a while. I'm looking forward to finding out. But as you can see, our net debt as a percentage of GSP by June 2028 is likely to be roughly half of what Victoria's is, which is the other major state, obviously, in the Commonwealth as well. We haven't updated these numbers to reflect the yesterday's budget from Queensland, and so we will as well. But you can see that we have been stabilising the state's net debt, and we are looking to keep it around that level. And again, it has required us to make some careful and deliberate decisions as well. I won't just labour the point about gross debt, but I will say that, as David has made the point, part of the reasons why we're able to achieve that is because we are starting to post some pretty healthy cash operating surpluses as well, which means we can use the extra cash that we're generating to defray the borrowing required for our infrastructure program. I should also say that when it comes to the cash part of the budget, that means we are no longer borrowing to fund our day-to-day bills as well. And the government can pay its day-to-day bills without having to ask the bond market for some additional resources. This hasn't been achieved by lowering our infrastructure program. It has been achieved by making sure we're prioritising our infrastructure program as well. And we are showing people what we expect the infrastructure program to look like. It's averaging about $29.6 billion over the next forward estimates period. But we are also making the point that some of that expenditure is going to be taking place outside of the general government sector. When it comes to our water utilities, when it comes to our power companies who are doing capital replacement and expansion, particularly to help us meet the housing crisis, we are going to be investing more in piles and poles over the time to come, while still building 25 metro stations as we speak, while still building a major crossing under the harbour, while still rebuilding many, many roads in regional New South Wales in the wake of disaster, and while making sure that we are building new public schools and putting more money into our health system as well. I just want to talk about the bond yields because I like to as well, but particularly important that we do send strong signals to the market about the stability of our fiscal management, because we do want the rewards of lower bond yields as well. As David has already pointed out, a 10-point movement funds quite a lot of programs. And if we keep a 10-point, even a 10-point basis point, it means we say yes to more interventions, be it in customer service, be it in to help us meet the cyber challenge, many other things. And I have to say, lots of people in this room who've been through this budget would know that we've had to make really difficult decisions about programs that are $10 million, $20 million, $30 million. And we've had to say no to lots of good programs that are of that size. We want to say yes to more of them. And I do prefer to pay our creditors less in order to fund our essential services more. So, talking about the economic context as well, very helpful that we concur with the RBA and the Commonwealth Treasury and others who say and expect that, in barring any major world shock, which we can't rule out, that we are expecting inflation to stay within the RBA's target bound as well. Pleasingly, real wages are growing, and that's incredibly important as a fundamental driver of cost of living relief. And when it comes to relieving cost of living pressures, we're clear we want to rebuild household disposable income, which means we want interest rates to be stable and lower. We want people's wages to go up. And you get those two happening at the same time, you start to take pressure off families. And if you happen to pair that with some big investments, so we're building more homes and houses here in New South Wales, you then start to ensure that not only are families getting more income, but they're getting more choices as to how to spend that, particularly in the biggest cost to households, which is the cost of housing. We do need to do more to get the economic growing faster. and we need to do more to lift productivity. I'm sure when Patrick and I talk, we'll talk more about what we're doing in that respect. But turns out the world is quite uncertainty. And I thank the Treasury team for finding this wonderful way in which to explain that in chart form. And this is simply the Economic Policy Uncertainty Index. And you can see that it became quite uncertain last year. And you can also see how the financial markets have responded to some uncertainty that was created earlier this year. Our point is, it is an uncertain time, which makes it far more important that we get our fiscal house in order so we're in a better position to cope with and respond to shock, come what may. Thank you very much for joining us. Sorry to keep you from your lunch. Looking forward to picking up the conversation afterwards. To all the public servants who I insulted through the course of this budget program, this Pigeon app that allows you to ask me a question is your opportunity to get your revenge. Thank you.